This time, this is a far, far greater mess. I mean, it is the end, if you like, of the fiat currency system. It's as simple as that. I think it's worse than 1929. If you see the US Treasury yield on the 10-year note going up above something like 4.7, 4.8%, then you kiss goodbye to the bull market in equities. The rest of the world actually is moving away from us. And thank goodness. I mean, we're in self-destruct mode, whereas the rest of the world, is going to be quite busy trying to protect itself from our follies. Collapse is underway first, then China protects herself with the gold standard. This idea of stable coins and all the rest, forget it. I mean, that's just rubbish. CBDCs, forget it. Whatever you can do to protect yourself and those around you, it is extremely important.
Hello everyone, Paul Buitink here, and welcome back to Reinvent Money, a podcast about money and power. Today I'm talking to my good friend and recurring guest Alasdair Macleod again, who is a former banker and stockbroker. He's also a renowned macro analyst and precious metals expert with a great newsletter and Substack over at macleodfinance.com. Today we're going to talk about our favorite topic, namely the risks of credit and fiat money and where we are in the debt cycle. Alasdair thinks today's credit bubble appears to be more extreme even than the conditions we saw in 1929 when the stock market crash ushered in the Great Depression. But I also would like to understand what comes next after the crash. How would a new financial system look like? What are these scenarios? Welcome, Alasdair. Good to talk to you again.
Thank you for having me, Paul.
Yeah. So first thing I wanted to ask you, Trump's mother's name is Macleod. Do you guys share the same ancestors? Or?
Well, I looked into it, she is a Macleod of Lewis, which is my tribe, as it were. But I can't see any relationship. I mean, we might be ninth cousins or something, but, you're ninth cousins with half the planet. So I think the answer to that is no.
Okay. And do you think Trump will stay in power much longer? Or will, for example, the whole Epstein mess lead to his downfall?
Well, I wouldn't rule that out. But, basically he's there. He's there for the term, unless we hear otherwise. The capriciousness over trade, I think, is really going to be his undoing. And that, to me, is very, very concerning. Now, having said that, there are two things which I actually quite like about Trump. He hasn't bought into this environmental, carbon stuff about how we're all responsible for warming the planet. So I think that's one thing, and also he's anti-woke, which I think is another very, very good thing. And that I think. Assuming he remains for the rest of his term, that I think is changing, if you like, the dynamics in other countries, and I think that's very, very important. I mean, from the social point of view, from the point of view of society, but I think his real Achilles heel is his very poor understanding of economics and trade.
And a constant flip-flopping and backtracking. And because in my intro, I talked about 29. And of course, you wrote about it extensively. So maybe we can make a link there that on the one hand, we have these credit conditions, but on the other hand, we also have, we had Smooth Holly in 29. Maybe you can explain to the listeners what that is all about and how this all ties in with the risks you see of a global recession and a collapse of the credit bubble?
Well, we've got these two things happening this time, just as they did in 1929 to 1932. You've got a credit bubble, and for those who, when you're in a credit bubble, you think everything's wonderful. Things are going up forever, and it's nice and comfortable, and we're getting wealthier, and all this sort of stuff. I continue to buy the momentum stocks, not the value stocks, because who wants value when you can get momentum? So that basically is a credit bubble. And, if you find it hard to understand that, then look at the other side of credit, because for every credit, there is a debit or debt. And And arguably, we're in a debt bubble. Unarguably. Therefore, we are in a credit bubble. And furthermore, bank credit has been angled at puffing up asset values. If you look at the Nasdaq numbers, from FINRA for margin debt, that's now over $1 trillion. It's never been this high. I mean, it really hasn't. This debt bubble is the largest credit bubble, is the largest in history. I mean, the other great one, of course, which really undid everything, was the Roaring Twenties, and when that ran into reality in round about September 1929. I mean, that basically collapsed the stock market in America by just under 90%. I mean, almost wiping it out. The other thing we had then, of course, and you referred to it, is the Smoot-Hawley Tariff Act of 1930. And basically, that introduced extra tariffs on top of the Fordney-McCumber tariffs of 1921. And it was indiscriminatory. I mean, basically, it wasn't just on consumer goods imported from other countries. It was from intermediate goods imported from other countries. It was also on commodities imported, or some commodities imported from other countries. And what have we got today? We've got exactly the same thing with Trump. I mean, we don't have a sort of Fordney-McCumber Act 10 years earlier, but I mean, you talk to people who've been advisors to Reagan and so on and so forth, who tried to roll these things back. I mean, even under Reagan's time, I mean, Steve Hanke tells me that, we've had these tariffs have just been going along the whole time. So this is, if you like, Smoot-Hawley Mark II. And there is the additional problem. Back in 1930, the US economy was a lot more contained than it is now. I mean, by that, I mean that the proportion of GDP which relies on imports, far, far lower. I mean, we were talking about, considerably less than 10%. Now, of course, it's a very different matter. And you've got supply chains all around the world. All those are basically being dismantled. You've also got the geopolitics. And this is something which, of course, in the West, we're not aware of at all. We're just not interested in geopolitics. But the fact of the matter is that over 70% of the world's population is forming a line behind China and Russia. We can try and produce rules, regulations, tariffs, and all the rest of it against the rest of the world. But the rest of the world actually is moving away from us. And thank goodness. I mean, we're in self-destruct mode, whereas the rest of the world, is going to be quite busy trying to protect itself from our follies.
Yeah.
I would say that the combination of this credit bubble plus Trump's tariffs, it's just absolutely unreal. I think it's worse than 1929. And on top of that, you've got another problem. And that is, in 1929, we had a gold standard. In other words, even, whatever happened to banks going bust and all the rest of it, if you had physical dollars or you had dollars in a safe place, in a safe bank or whatever, then their value was guaranteed. So you had an escape, if you like, from collapsing asset values. This time, there's no escape. We don't have a gold standard. It just basically will collapse the currencies. So, we've got all these things happening at the same time. And one way of putting it is you could say that the fiat currency era is coming to an end. It's the death throes of the fiat currency system. Because what do fiat currencies do? It allows governments to do things to excess. You can't do that forever.
Yeah. And because of the crisis in 29, 30, 31, a lot of Americans decided to exchange their dollars for gold, right? Which eventually led to Roosevelt making it illegal for people to own gold in 33, 34. Yeah. Is something like that going to happen as well, you think?
Well, I'll take a rain check on that. I wouldn't rule it out, really, on the basis that politicians are not driven by common sense. They're driven, if you like, by what the electorate demands of them. And, when you see some people getting rich in gold and silver, it would be wrong to say that even the most sensible politician would not be tempted to do something about it. So we wait and see.
We'll park
if they do it, I tell you, gold and silver will be bid only, which is market jargon for there will be none available. And if you want to get any on the black market, whoa, it's up, 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 up. And you probably won't get it anyway. So, the answer is that you've got to have your gold and silver long before that. But there is another aspect to this, which I haven't yet mentioned, and I think we should throw into the pot. And that is, with the end of this fiat currency era, we're also beginning to see the end of the derivative era, which has built up particularly since the 1980s. That I don't think anyone is really seriously looking at. But if you see now, I mean, we've had, particularly in metals and commodities generally, the demand for commodities and precious metals has really been from Asia, from the dynamic economies, rather than ours. We have been sellers. And what we have done is we've tried to suppress prices basically by increasing artificial supply in the form of derivatives. We now have a situation where, China in particular has benefited from this. We've suppressed the prices so that China has been able to buy these commodities cheaply. What she has done is she has accumulated inventory. I mean, she didn't tell us that she's accumulated huge quantities of silver, gold, platinum, palladium, copper, whatever. But she has. And in the past, she's been perfectly prepared to feed a bit of it into the market to try and stabilize prices. And this is particularly the case with silver. Now what's happening is she's no longer doing that. She sees the end of the fiat currency system, and she doesn't want to part with her stocks of metals, which she actually needs, whether it's to, form basis of money in the case of gold, or whether it's for industrial purposes, particularly silver and copper and so on. I mean, she's hanging on to her stocks. So the liquidity, which the derivative markets depend on, the physical liquidity, is disappearing. It's gone. It's going. And
people want the physical stuff, and people are also pulling away chairs from the game of musical chairs, especially central banks repatriating gold. Yep. Withdrawing it from the liquidity centers. Like the other day I saw Serbia wants to have all the gold on its own soil, and they're already at 95%, but soon they will be at 100%. Yeah. Hungary has like 75% of the gold stored. And we saw, of course, in the past also Germany and the Netherlands retrieving their gold. So that's all part of this collapse of the paper market, then, I would say.
Yeah, absolutely. But then think on this, Paul. When people begin in the West to wake up to this, then what price precious metals? I mean, what price anything? Because if you look at, quite simply, the area which we concentrate on, which is really gold and silver, in commodity terms, if you like, particularly gold is under-owned in terms of futures, because the level of open interest in the futures market in COMEX is about 450,000 contracts, which is sort of marginally oversold. I mean, it's not overbought. But just imagine what happens when the managed money category on COMEX decide, hold on a minute, we can see that there's a huge, great squeeze yet to develop. And they take open interest up to sort of 600,000 level, which they have done before. What happens then? There's no stock, nothing. I mean, the squeeze is going to be on the system. And how do you bail out the system without any physical?
Yeah. No, it's impossible. But like in the 29 and then the 30s, it's something that Bernanke always complained about when he was reviewing that period, that there was not really the opportunity for central banks as easily as now to create money out of thin air. And now we have QE. So now central banks, governments can pull more tricks in order to at least delay the inevitable crisis, to kick the can a bit further down the road. I mean, all governments, all G7 countries, but also China, they've been very willing and creative with kicking the can down the road. So don't they have more tools available to at least delay the inevitable for a few more years?
Well, we're moving on from commodities, physical commodities and precious metals into credit. I have absolutely no doubt you're right. I mean, it's very easy for a central bank to expand the quantity of credit to rescue the system. I mean, when you get increasing bad debts. Oh, and another thing which we must understand is that when you get a credit crunch, such we're likely to see, credit being taken out from the system, the price of credit, in other words, interest rates, go through the roof. We're going to see that. We've yet to see that. This is why the long end of the bond markets are so sticky. We just can't get the rates down.
Right. Yeah. No.
They're going to go up, I can tell you. I mean, I experienced this in the UK back in 76 when we had, in fact, actually earlier than that, in 73, when it collapsed the whole of the commercial property market in the UK. That was October, November 73. I mean, we were in what we call stagflation nowadays, in persistent inflation, and yet unemployment was rising. And, I mean, it was something which the Keynesians couldn't explain at all. But we had interest rates of over 15%, or rather, we had bond yields of over 15%. I remember the issue of the 15s, the 15 and a quarters, and the 15 and a halves of 1998 gilts.
Yeah.
I mean, imagine what that does. That's where we're going with bonds. Okay, so the consequences of this are that not just government, but also the private sector, we're so full of zombie companies, who basically have geared up on debt because of ultra low interest rates over the last 10 years or so. And consequently, they will go bust. And that means that the banking system goes bust. So what does the Fed do and other central banks do? Well, the answer basically is they buy these debts at face value off the banks, which they could do because they don't have to mark to market. So basically, it's all hidden, if you like. The losses get hidden, if you like, on the central bank's balance sheets.
But don't you think the central banks will step in again? Like in 23, of course, when we had the bank, the problems with Silicon Valley Bank and some of the other banks, the Fed intervened. So there could be, I think, a chance that central banks across the world, that G7 central banks, they will start buying up all these assets again on a broader scale. And for example, Chris Martenson, when I talked to him the other day, he expects the Fed to triple their balance sheet. And I think the same could happen to the ECB and the other central banks. So they would suppress the yields of these assets.
Yeah. That's precisely what we're talking about. I mean, basically, how does a central bank pay for all these assets it buys off the commercial banking network? I mean, the answer is it creates the credit out of thin air in order to do it. In exactly the same way that a commercial bank creates credit out of thin air when it lends you some, some dollars or euros or whatever. So, I mean, what this means is a real acceleration in the quantity of currency. That's what it boils down to. I mean,
right, yeah.
Currency being basically not only cash notes, but also commercial bank reserves on the central bank's balance sheet. It's going to explode. I agree. Forget 3 times. I don't know how many times it's going to explode, because you've also got governments with their deficits, which will be ballooning because tax takes will go down, welfare payments go up. I mean, the whole thing is a catastrophe, which can only result in the collapse of the currencies. This is what I mean by the end of the fiat currency era.
Yeah, because this is the mother of all bubbles. Basically, we had in 2000 we had of course the .com crisis. We had in 2008 the financial crisis. So we've had previous crises, but they were more relatively small, still big. But compared to what's coming now, this is like the mother of all bubbles and crashes, because all assets will be sucked up then by central banks, government debt, real estate debt. corporate debt, credit cards, everything will be sucked into the balance sheets then of the central banks, and the only thing they can do is create more money, and that will eventually lead then to high inflation across the board.
Yeah, I mean, the more you look at it, the more difficult it is to deal with, because if you have your run-of-the-mill crisis like the Lehman crisis, which they call the Great Financial Crisis, this one is going to be even greater, I assure you. You can sort of see, okay, at that time, the Fed did exactly what we've been describing. They basically wrote an open check for the commercial banking system and the derivatives markets and said, here, you got a problem, we bail you out. Take as much money as you need. I mean, that's what the Fed did. But this time, this is a far, far greater mess. I mean, it is the end, if you like, of the fiat currency system. It's as simple as that. What will trigger it? Well, it can be anything. I mean, we've got a crisis developing in the relationship between physical metals, particularly precious metals, and derivatives. So that's one problem. Another problem is that bond yields are going to go a lot higher, and I think they will start going higher when people get back from their holidays and sort of start thinking, oh dear, we don't like the look of this. I mean, foreigners own $40 trillion and underlying assets, dollar-denominated financial assets. Are they going to hang around there? I don't think so. And indeed, I think what we're seeing with commodities, and particularly metals, is you're beginning to see governments and also the very, very big trading conglomerates getting out of dollars and getting into physical metal, the physical things they need. I think they're beginning to move in that direction.
So, and at what yield level, will the Fed step in then and start with yield curve control, like Japan has been doing, and of course they let it go a bit now, but the European Central Bank has been doing that as well. Of course, during the euro crisis, they will not let yields perhaps go higher than, let's say, 6% or so, 7%.
They can't prevent it. Honestly, they can't prevent it.
They can't control that part of the curve. The long end they can't control.
No, they can't control it. No.
And I mean, maybe they can still use the dumb money to buy, let's say, the pension funds, because in Europe, especially, pension funds they still buy up a lot of that debt, also for regulatory reasons, and with the consumers and retail investors, of course, paying the price for that in the long run.
Yeah.
So those venues they can also still use in order to dump the bonds on.
Well, the problem there you have is that the pension funds and also the insurance companies, which need to do long-term debt and credit matching, they're not big enough to absorb this problem. They really are not. You can regulate and legislate and all the rest of it, but forget it. They can't deal with it, honestly. I mean, at the moment they've been sort of, relatively happy, perhaps not terribly happy, to take relatively low yields because, as you say, the regulators force them to do so. The actuaries as well force them to do so because that's the only thing available. And that's going to continue to be the situation. And in a sense, I mean, the pension funds would welcome higher yields because they're getting, I mean, their obligations are beginning to exceed their returns by increasing amounts. I mean, they really are. And there is another thing. I mean, particularly in this country, I haven't done the arithmetic in America, but in the UK, roughly a third of the gilts are actually index linked. Now, what happens? What happens to the debt to GDP numbers when you get falling purchasing power for the pound? I mean, the answer is, it's going to soar out of control quite quickly.
Yeah. And you also notice that a lot of governments are trying to issue more short-term debt, right? So the duration is also changing because of the high long-term yields.
Yeah, they've got no alternative, Paul. Yeah. I mean, because nobody will buy the long stuff.
No.
I mean, this is, you have the situation in America where Scott Bessent, he's obviously facing this problem. He's, the Treasury have talked to the Fed and said, what can we do about it? I know what we can do. We can do away with the supplementary leverage ratio. And I mean, I kid you not, I was watching a sort of committee meeting of the Fed, which for some reason was online. I don't know. And you had the lady who was responsible for, global compliance, saying, well, in terms of Basel III, this should not be a problem. I was thinking, yeah, quite, yeah. Well, I agree. But I mean, the ridiculous thing about Basel III is it assumes that government debt is risk-free. What?
Yeah. Yeah, that's the biggest joke in economics. Then I think of this time and day. I think yeah. And what about the stable coins? Then is that not a venue the US can successfully deploy to delay a little bit longer the inevitable?
I think they're running out of options. It's as simple as that. I mean, we all knew it. I mean, big joke. Really, I mean, certainly ever since we started working together, which is 12, 13, 14 years ago.
Yeah, 14 years ago, right? Yeah.
The big story always was they're kicking the can down the road. Yeah. Well, I mean, I think that the Fed has got gout in its big toe and it can't kick it anymore because it hurts too much.
Yeah, exactly. And they have sore feet, and there's little road left. So what comes next then, Alasdair? If we see a crash or we see a high inflation and a breakdown of the system, people choosing alternatives, people basically demanding a reset or a different currency, or what are we going to see afterwards? Because what I see for now is a divided world where you have perhaps a G7 currency or versus a BRICS currency. Can you give me a little bit your vision on how the financial system globally will evolve after this massive crash that we are going to witness?
Yeah, I mean, I don't think we'll end up with the answer immediately. They'll probably go down a few rabbit holes and get it wrong. But the answer, actually, there's only one answer, and that is the legal one. The legal one in everybody's common law, and that is that you have to tie the value of credit to what is called corporeal money. In other words, money which actually exists with no counterparty risk, and that's only gold. So we have to get back onto gold standards, in effect, working gold standards, so that the value of credit, because gold doesn't circulate. I mean, you don't end up paying things except as the last resort. Do you actually part with gold? It's always credit. Credit has to be tied to gold, and that's where we've got to get back to. They'll go down. They won't get there immediately. I mean, we won't. I think there's a very strong possibility that China is planning to go in that direction. But this is a defensive move as far as China is concerned, because she won't want her currency, which will be central to the new world, if you like, the new world away from us. She doesn't want her currency to collapse with the dollar or anything. I mean, she's quite happy to run a fiat currency system while the world is in a fiat currency system. But when the dollar really does tank, I mean, she's going to protect herself. And, it's a sensible policy, because if she was to do it now, she would be accused of collapsing our system. She doesn't want that. So, it's sort of collapse is underway first, then China protects herself with a gold standard. And Russia, incidentally, Russia can do it tomorrow. Russia, I think, probably wanted to do it yesterday, but the Chinese have persuaded them to stay the hand. So that's what's going to happen. The rest of the world is going to go onto a gold standard via the yuan in particular, and any other currency goes. And I mean, China's already planning to do this. She's opening Shanghai Gold Exchange vaults in Hong Kong and Saudi Arabia. Why Saudi Arabia? Because of oil. It's an oil to yuan to gold exchange standard in the making. Hong Kong is the financial center, if you like, the offshore financial center for China's capital activities. So, yeah, I mean, you got those. I think she'll probably open vaults elsewhere. I mean, you may recall that when on April the 2nd, or just after April the 2nd, when Trump had his, all these boards with all these rates that he was getting, tariff rates that he was proposing, President Xi the following week went round all the, well, not all of them, but most of the ASEAN nations in the district, talking to, to Thailand, to Vietnam, to Cambodia, to, Malaysia and Indonesia, I guess, as well. And now we don't know what he was saying, but I think quite simply, he was saying, look, we've got to band together on this. Now, of course, you band together on trade. ASEAN being a free trade area, they will bring in particularly Japan and Korea, South Korea. You can talk trade, but then you've got to talk about a settlement currency. And it's plainly not good enough, for example, to accept Indonesian currency, which, is going down and down and down and down. Why would you want to take settlement in that? You don't. So this is, it's clear to me which way this is going. And, we're sitting here with all our wonderful Keynesian ideas and gold as a pet rock and, in denial and all the rest of it. And how long are we going to take to turn that ship round? The ship of understanding. That's exactly what we've got to do. Because apart from that, you can't just go onto a gold standard. You've got to also change the government's outlook and its responsibilities and its relationship with the economy. And the answer is that, we basically, governments are in the business of wasting financial resources.
Yes, you need a cultural change as well. Right? Before you can make a real monetary change, you need a cultural or mindset change. And perhaps what we see in Argentina at the moment, where Milei has been quite successful and popular, and a lot of voices, especially also in Europe, are also calling for a Milei here. But like we've seen time and again that governments have not been good stewards of our money. So would it now be the chance and the time to come up with proper market-based currencies? I mean, we can run a gold standard using gold stablecoins, for example. We don't need government to manage it for us. In fact, if we give governments the control again, then they will probably screw it up at some point. So would it now be the time, with the technology we have, to start successfully using private currencies, making it impossible for governments to tamper with them?
No. Forget it.
I'm too hopeful.
I mean, your governments, for a start, if you start trying to deal in, say, take settlement in gold or gold stable coins or whatever, are you really going to do that? I mean, people, they do their business in euros. Come on. The euro goes down, okay, we might do something with our savings or whatever, but when it comes to day-to-day purchases, no, you use the collapsing currency, just as they did in Germany in 1922-23. This idea of stable coins and all the rest, forget it. I mean, that's just rubbish. CBDCs, forget it. I mean, the authorities would love to introduce them, but it's not going to work. And furthermore, the crisis is now, not tomorrow. This is the whole point. I really do think that when people return from their holidays, I mean, just bear in mind that the top of the market in 1929 was September. We're coming up to that. I'm not saying that it's going to top out in September. It may have already topped out. I don't know. But I can see that when people come back from their holidays and they see the deteriorating domestic and global situation, they're going to be reorganizing, if you like, their investment strategies. And that's going to start, I think, the collapse. And I think you'll also see at that stage, if you see the US Treasury yield on the 10-year note going up above something like 4.7, 4.8%, then you kiss goodbye to the bull market in equities. The relationship between equities and bonds is already twice as stretched in valuation terms as it was at the dot-com bubble. Twice as much. This is a bubble like no other we've ever seen.
So, what's your outlook for the stock markets this year? Then, what kind of pullback do you expect in autumn?
Well, I mean, when it peaks, which it may, as I say, it may have actually done. Basically, I can't see what can stop it really falling and falling and falling. Do you want to catch a falling knife when bond yields are rising? And you'll see that 10-year note going through 5% very, very quickly. Under those circumstances, do you want anything? And bear in mind also, you've got $1 trillion of margin debt in the US stock exchange and derivatives and all the rest of it. I mean, all this stuff is collateral on the bank's balance sheets. What do? They start selling as well because the value of collateral no longer covers the loans. Margin calls, if you like. I mean, we know what margins are like in the derivatives market, but we're talking about more serious margins on debt, if you like, speculative debt, which the banks have been financing to the tune of about $1 trillion. And then, of course, you've also got, this is something I know that you've done extremely well out of, but you've also got the crypto market.
Yeah, you're not a big fan of crypto. At the same time, Trump really wants the US to become the crypto capital of the world, and he's constantly coming up with legislation like the Genius Act and other acts in order to make crypto flourish in the US. So wouldn't that be a great thing for people to invest in the coming years, given everything Trump is doing?
I'll tell you what, Paul. I mean, if you look at what Bitcoin has actually been doing, it correlates with the Mag 7. And it's like a Mag 7, except it's got no assets, no business, and it's just got a concept. And that's it. And it's got a lot of punters in there just looking for, we're making money, we're making money. That's the only thing. They're not actually thinking this is an alternative to fiat currency because they'd be going into gold. What they're thinking is that I'm going to sell this for $1 million because Saylor, or whatever his name is, reckons it's going to go to $1 million. That's actually all it's about. So when the credit bubble pops, that's going to get wiped out completely. It's not money. It cannot be legally money. It cannot legally be used as a means of exchange.
Yeah, but laws can change, of course, Alasdair. I mean, that something is legal money at some point doesn't mean it will be legal money forever, right?
Laws can change. Okay. Trump's timing on this reminds me slightly of the Fed's timing in buying bonds, QE, when the 10-year Treasury yielded 0.6%. What does it yield now? What are the losses on their balance sheet? I mean, the timing was exquisite from the point of view of screwing things up. I see exactly the same thing with this genius called Trump. I mean,
stable genius, right? He used to call himself once. Yeah. But what I still struggle with a little bit is then, are you not underestimating then the power of the central banks to stop this scenario from happening? Because when yields go too high, they will just buy up all these assets, and of course, maybe in the long run, markets will dictate. But in the short run, perhaps the Fed, ECB, they can suppress yields, pump up prices of all sorts of assets, bonds, shares, and the bubble can continue for quite a few more years. Why would it pop? Why would the Fed not try to stop that?
I think we've answered that question. Basically, yeah, they will try and do it. And basically, what they will do is they will dilute the purchasing power of their currencies. The currencies will just take it on the nose. That's what's going to happen. They've actually got no option but to try and rescue the system by inflating the currencies. And that's going to happen. I mean, that is for sure. And it's going to collapse the fiat currency system completely.
Now, it's going to lead to higher inflation, and that will then suppress yields. So you have financial repression, yield curve control. Perhaps they will abolish cash, introduce CBDC. There's all sorts of things they can do to keep it from going, right?
When it comes to CBDC, how long will the planning be in order to ensure that the central bank, even though it might be issuing them through commercial banks and all the rest of it, can actually track these CBDCs so that they can be, let's say, directed at financing R&D in AI or whatever the department is. I mean, this is Bank of International Settlement rubbish. Let's face it. It's going to take 10, 15, 20 years when government committees go through all this rubbish. And for a start, one of the 3 acts which the Americans brought in, one was the sort of crypto stuff, with stable coins.
Stable Act. Yeah.
Another one was actually banning the Fed from CBDCs.
Yeah, that's the US, of course.
In America, forget it elsewhere. It's not going to happen anywhere.
No, I do agree with you that there's a lot of people out there who think CBDC will be introduced already this year across the globe. And of course, in China, there's experiments, but especially Western bureaucrats and officials, they probably need many more years in order to come up with something that works for a little bit. So we have time in that sense, because I'm not a big fan of CBDC. But I also don't see the reason to be afraid about it in the short run, because it will take many more years for the ECB at least to launch something that it's close to anything workable.
If America doesn't do it, nobody else will do it. We've got a dollar-based fiat currency system. What America does, we follow.
Yeah,
and America's ruled it out, so forget it. It's not going to happen.
Well, Alasdair, so but then to answer my question, what will happen with let's say Western currencies? Are the Brits still going to use the pound after that crash for day-to-day use?
I mean, well, use the pound. Doesn't matter what the value is. I mean, it might buy absolutely nothing, but we'll still use it just the same as they use the currency in Venezuela. Sure.
Yeah.
We go down with the currency. One thing that this nation has done historically really quite well is when it's really got its backs up against the wall, out of nowhere, perhaps, comes some sense, and someone comes up with a solution, and it works. I mean, that's the only hope we've got, really. But I can't see where it's going to come from. At the moment, we've got, a left-wing government which is completely powerless against its own parliamentary party, even. I mean, they tried to get some much-needed welfare cuts in place. And what happened? You had a complete rebellion in the House of Commons, so they had to drop it. So the only thing they can do is just raise taxes. And it's, I think it was Margaret Thatcher who said the problem with socialism is they just basically take everything you've got until there is nothing left. So
yeah, or that you run out of other one's money, right? That's also one of her quotes.
So the last person leaving the country, please remember to switch off the lights.
Yeah, well, at least you guys, the Brits, the Americans, have some sense of national identity and pride. And if you look at Europe, of course, it's even a bigger mess, because I totally see why the pound would still be there. I mean, it's been around for hundreds of years. Same applies to the dollar. It will lose value for sure, but the euro, for example, it's just it's been a mess from the start, and I don't know if it can survive a big crash. Countries will probably pull out, or how do you see that?
I think it's a very interesting point, actually, because the point about a currency is that the longer it's been in existence, then, if you like, the more likely it is to survive. But the euro has only been in existence since the year 2000. You still have the memory of national currencies, and particularly in Germany, of the Deutschmark. So I can see Germany in particular thinking, look, we've been down this road before. 1922, 1923, 1946 to 1947, when our currency has been wiped out. And here we are. We've given up the Deutschmark. We were backed by gold. At the end of Bretton Woods, we still had the elements of sound currency. We got to get back to that, and the only way you get back to that is just get out of the euro. I can see that sort of thinking developing. So I think you've got a very fair point. The currency which is least likely to survive this, I think, is the euro.
Yeah. And I know many countries have already backup plans, also here in the Netherlands. Of course, they're being kept secret because they don't want to frighten markets and citizens. But for sure, there are all sorts of plans already available in order to make a smooth transition to a local currency, like to a national currency.
Yeah. I mean, I think you're right, and I mean, when there are elements, I think, in Europe which actually see what we're discussing. They see these dangers. They probably don't see it as being as urgent as you and I are discussing it, but they do see the direction of travel, and basically they're beginning to think of a plan B. And this is something we've really got to consider. And I think as the collapse, which of the credit bubble, I mean, this deflation, I think, is going to be really quite dramatic. As that happens, I think plans will be accelerating. We'll find that all this sort of discontent. I don't think anything will be ready at all by any manner of means. But I think this sort of conversation will resurface. I can see Hungary, for example, Germany, the Netherlands. I can see those countries in particular, and maybe some of the newer Central European countries, within the euro system. And outside it, beginning to really question the thing. I mean, why has Poland been buying gold? I mean,
and not joining the euro. They should have joined the euro a long time ago, but they're not doing it for a reason.
Yeah.
When I'm hopeful, I think it's actually ultimately a chance for Europe to get stronger, to be more focused on trade and peace instead of this forced political union with a forced political currency. I mean, on the ashes of a crash, also in Europe, hopefully will grow something more productive and more sustainable that respects also the diversity we have within the continent.
Yeah, no, I agree.
Well, thanks so much, Alasdair, again for your time. Any closing remarks from your end?
Well, I think we've pretty much covered the waterfront. We've probably frightened the audience.
Yeah, I mean, I know we've been too early for many years, right? We've been talking about these things for so long, but I think it's better to be too early than a little bit too late, and hopefully our viewers will not be too frightened. Hopefully they'll just think for themselves, do their own research, and look into the things that you've been saying and verify for themselves whether they make any sense.
And I'm particularly worried about the future for ordinary people, which is why I set up my Substack. I just want to spread the word a lot more widely than to, if you like, a captive audience of gold money. I just wanted to get out there and get as many people as possible understanding what is happening and why, if you like, middle classes should no longer be looking to increase their wealth. They should be looking to protect it, which is a very important difference.
Yeah.
I'm also working with other leading outfits towards that end. I mean, I recently joined Egon von Graetz as an advisor, von Graetz. And also I'm an advisor to As Good as Gold Australia, which is one of the leading bullion dealers over there. And we're sort of coming together. I think there's a coming together, if you like, of some of the more serious minds in terms of understanding how important it is for ordinary people to protect their wealth rather than try and speculate to accumulate. I mean,
what would you say to the young people, for example, that have not yet accumulated wealth, and let's say you're just graduating and you want to start your career, you have no money yet, maybe even debt because of university. What do you advise those people to do then?
Well, I think it's very difficult. I mean, I really do think it's extremely difficult, and it's not just the young, but you just look at everybody who has been relying on government to provide them the welfare to, either, in its entirety because they're not working or they don't want to work or they're disabled or whatever, or they're pensioners. I mean, pensioners are going to be really wiped out by this. You've got to have, the only thing that can happen is you've got to have some wealth and you've got to protect that wealth. And the only way you can protect that wealth is just to get the hell out of credit. And remember also that you're part of a community. Everybody is part of a community. And so your responsibilities under those circumstances are not just going to be to yourself and your close family. It's going to be, you've got to think about your community as well. I think this is not going to be easy for anyone. It really is not. So, but I'm afraid, just the same as the tide comes in every day, this one is like a tsunami. And, whatever you can do to protect yourself and those around you, it is extremely important. And you may disagree with what I've been saying, maybe, Paul, with what you've been saying. But for goodness sake, think about it seriously. I mean, it's desperately important. It really is.
That's good advice. Thanks, Alasdair, and look forward to chatting with you again in the future. Perhaps we could even do it in real, in person next time. Let's see.
That would be great. Yes, lovely. Oh, anyways, thank you very much for having me on, Paul.
Yeah, and people should go to, of course, your Substack. So that's MacleodFinance.com, right?
Well, yeah. If you Google Macleod Finance, but the actual address is alasdairmacleod.substack.com.
Yeah, I'll put the links in the show notes, and of course, viewers, please subscribe to my channel as well, and like this video, share it widely, and see you next time. Thanks, Alasdair.
Thank you.